And the big four do not give a shit about the emerging Australians. Every single day, I'll be posting videos explaining the finer details about property, mortgages, and everything to do with finance for you to learn. Information that's relevant to today's market. Today, I'm going to go through and detail the different kinds of mortgage providers: banks, non-banks, non-conforming. In terms of banks, we'll start with the major four. The major four is a mix of 5 or 6 different organizations nowadays because they have bought into different companies. For example, CBA owns Bank West, Westpac owns St. George, and so on and so on. The major four, the top tier banks, apply to a specific kind of clients with a very low risk appetite for lending. When you're dealing with a big four or an extension of a big four, you need to be essentially either really well off as a business owner with a proven track record, or you need to be a PAYG employee with a very simple status, high deposit, and a means of continually showing that. This is not for people emerging. This is not for people growing their wealth. Unfortunately, all the products of the big four, despite their marketing, are designed for the haves as opposed to the have-nots trying to get. The tier down thereafter are the non-banks. People like your ING, your Macquarie, all those different firms have different structures designed to support and facilitate your growth. These are companies like our company, Empower Money. These companies have got products that cater to different niches. Those niches include things like SMSF, that's getting a property inside your super. These include things like higher LVR products like ours, which is 105% lend for owner occupied and investor. That's for people who have zero deposit, all the way through to 95% lend, 90% lend, easy refi. For example, we have a product that if you've got 12 months in the same history, we can refi your deal straight away with just 12 months history without looking at your finances, provided we can get you a cheaper rate. These are all unique products designed to advance and get you to move ahead. After that, there's what's called the non-conforming lenders. Non-conforming lenders are targeted to help you get into properties without actually showing certain things. For example, there's a practical side to business ownership that relates to a product to help you get a property without showing financials. This is called a low doc or a light doc application. A non-conforming lender helps business owners, for example, get in without showing their tax returns and financials for key reasons. Key reason number one would be that your financials aren't ready. We have till September next year, for example, to do this year's current financial tax returns as business owners. But also another reason is there is a unique scenario in Australian tax law which says that your job as a business owner is to reduce your profitability on paper, which is invest and expend more so that you pay less tax, even though you are likely earning significantly more. You're investing to the future. So if your accountant can show and demonstrate that you are earning enough money, they can simply write a letter to the bank and say, I expect my client will earn X as a result of their business endeavors. And that is sufficient enough for that non-conforming lender to help approve you a loan at an 80 or 90, 85% LVR. Every single bank in the ecosystem plays a part. There is no one bank that facilitates all things to all people. And although they are targeting the everyday Australian to see their brand exposure, they do not want all Australians. The reason non-conforming banks exist is because they trust the security being the bank, being the asset. So they are happy to take higher risk on the client because they know that the security will hold. But they take those high risk clients because they want to charge a higher interest rate. Also, the non-banks, they're not targeting the same clients CBA, Westpac, and NAB are targeting. They know they can't compete with a banking institution in Australia that takes deposits from clients and pays them 1.5% interest on their cash and then lends it to the individual at 5.5%, 6%, 6.5%, 7%. They can't compete on that cop space. They can only target niches that the big four do not want to deal with. And the big four, unfortunately, despite the advertising, do not give a shit about the emerging Australians. They are there to de-risk themselves and only target, I would say, the top 1% to 2%. They have to protect their shareholders because of their size and have the most vanilla clients in their book, and they can because of who they are. And that's all perfectly fine. That would only be a problem if non-banks and non-conformings didn't exist. This is why you always go to someone like us or as a mortgage broker to see where you fit. Simply going to your bank branch and saying, I want a home loan, does not work anymore because that bank is a lender, not a broker. They are not obligated at all to tell you that their product does not suit you. Their job is to put a square peg in a round hole, and if it doesn't work, kick it to the side, and then you get a marketing credit score. Whereas a mortgage broker looks at all the products in the panel. Forget about the brands, the products are what matter. How do they make the products in that market fit your scenario to help you either buy a new home or refinance your existing home to get an equity or refinance to get a lower interest rate? In the world and ecosystem of finance, there's been a dramatic shift towards brokerages, advisory firms, and things of that nature that can help structure a situation to you. Now, I'm a lender, but I have a mortgage broking arm as well. And with my particular situation, I go to the mortgage broker because not all situations suit the asset and suit my intentions, my goals, and my current situation. There is no one bank that facilitates all the needs I need, all the things I need. I can't call CBA, I can't call Westpac, I can't call NAB and say, can you fix X, Y, Z? It just doesn't work that way. The number one thing you have to know about lending and finance is different strokes for different folks. And the best way to get that is through a mortgage broker, through an advisory firm to help you get your outcome. Your goal is number one. Number two, your current situation. If you have a goal and a good stable base to build off, then the scenario of a refinance or a purchase is quite simple. It's just then about fitting the product in. The knowledge of the broker is what gets you there, not the lender. Tip ones around the banks, there's different kinds, and where you fit on them is very dependent on what you're trying to achieve. Hope this helps. Stay tuned for the next one. Guys, we are getting thousands upon thousands upon thousands of views a day. Please like, subscribe. If you're loving the content, press the notification button. Jump on board. More free advice just for you.